Introduction. Have you ever entered a trade not because it made sense, but because you couldn't stand the thought of missing out? Maybe it was a stock flying up on social media. Maybe it was Bitcoin breaking resistance. Maybe your friend made a quick profit and you felt behind. So you jumped in. Too late. And then you watched your money bleed. That's FOMO, the fear of missing out. It doesn't just mess with your emotions. It destroys your discipline, hijacks your trading plan, and turns your potential into regret. If you've ever felt anxious watching green candles, if you ever chased the trade only to be the last one in, if you've ever told yourself, "This is the one," but it wasn't, this book is for you. In the next few chapters, you'll learn how to recognize FOMO before it controls you, how to build a calm and confident mindset, and how to trade with clarity, like a professional. Because real success in trading doesn't come from speed. It comes from emotional control. Let's fix the fear and finally take back control of your
Chasing
trades.
green candles. Have you ever looked at a price chart, saw a massive green candle shooting up, and suddenly felt your heart rate jump? You tell yourself, "I'm missing it. It's taking off. I have to get in now." And before you can even think twice, you click buy. A few minutes later, the price drops. You're stuck. And now you're wondering, why did I do that? That moment when your emotions override your logic is the very core of FOMO in trading. And this chapter is all about that. Let's be real. Every trader has been there. Whether you're new or experienced, the feeling is the same, a mix of excitement and panic. You're afraid the opportunity will slip through your fingers, and in that moment, logic dies. The chart doesn't matter, the setup doesn't matter, your plan goes out the window. All that matters is the green candle. But let me ask you something. Why are green candles so seductive? It's not just because the price is going up. It's because we're hardwired to chase what looks like success. A green candle is visual proof that something is happening. It creates urgency. It triggers our brain's reward system. You see others winning, and your brain screams, "I want that too." Now imagine this. You're scrolling on Twitter and you see a trader post a screenshot of a $3,000 gain on a trade you missed. Suddenly, you're not thinking about your system or your rules. You're thinking, "I could have made that money." That thought lingers. It eats at you. So the next time you see a chart moving fast, you're not evaluating the trade, you're chasing the feeling you missed. This is the psychological trap. The market isn't just a place where money moves, it's a place where emotions get amplified. And nothing amplifies emotion faster than seeing price go vertical. That's why we call it chasing green candles. Here's something most traders don't talk about openly. FOMO doesn't feel bad in the beginning. It actually feels exciting. You feel alive. You feel like you're about to catch the move of the week. But that excitement is short-lived. It turns to regret fast. Because most of the time, when you enter late, you're the last buyer. And after the last buyer comes in, there's no one left to push the price higher. That's when the drop happens. That's when you realize you were chasing, not trading. Let's talk about the difference between chasing and trading. A trade is something you plan. You wait for a level, you wait for confirmation, you know your risk, you've journaled this setup, you've seen it work before. A chase is emotional. It's fast. It's impulsive. You're reacting, not thinking. And most importantly, you have no exit plan because you never had an entry plan either. The reason chasing feels so dangerous is because it's disguised as action. You feel like you're doing something. You feel like you're being proactive. But in reality, you're just being pulled by emotion, and emotion is the worst trading strategy there is. Now let me share a story that might hit close to home. A trader I coached, let's call him Jake, had been studying the markets for 6 months. He had learned risk management. He had built a simple strategy around support and resistance. He journaled. He did everything right. But one day, he saw a small cap stock explode on volume. The ticker was trending everywhere: YouTube, Reddit, Twitter, Everyone was saying, it's going to the moon. Jake had never traded small caps. He didn't know the float. He didn't even check the news. He just saw a green candle and a wave of hype, and he bought in. Within 10 minutes, the price dropped 40%. Jake froze. He couldn't sell. He held, hoping it would bounce. It didn't. He lost $1,400 on that trade, more than half of what he had made in the past 3 months. All because of one thing: FOMO. What hurt Jake wasn't just the money, it was the betrayal. He had betrayed himself. He knew better. He had a plan. He ignored it. That's what FOMO does. It makes you throw away everything you've built in one impulsive moment. Now you might be thinking, okay, I get it, but how do I stop chasing? Good question. The first step is awareness. You need to catch yourself before the emotion takes over, and that requires slowing down. When you see a big green move, your job isn't to react. It's to pause. Ask yourself, is this a trade I would take if I didn't see the big candle? Does this fit my strategy, or does it just feel exciting? What's my risk if I'm wrong, and am I okay with it? If you can't answer those questions with clarity, you have no business entering the trade. Because if you can't manage your entry with logic, you definitely won't manage your exit with discipline. Another tool that helps is trading without watching the live P&L. Most traders who chase are addicted to the idea of fast money. Watching the number go up feels like a video game. But that screen is not your friend. It's a casino pulling you in. Focus on setups. Focus on process. Money is the outcome, not the target. And here's a deeper truth. Most of the best trades don't feel urgent. They feel boring. They develop slowly. They give you time to think. If a trade feels like you have to enter right now or you'll miss everything, that's probably not the one you want. Let's talk about social media for a second, because it plays a massive role in FOMO trading. Every day you see traders post their wins. Big, green days, perfect entries, huge percentages. But what you don't see are their losses. You don't see their mistakes. You don't see their anxiety. Social media is a highlight reel. It's designed to trigger FOMO. You think everyone is winning. You think you're falling behind. So you overtrade. You force setups. You jump into moves that already ran. You compare your chapter 2 to someone else's chapter 20, and that comparison becomes poison. The only way to avoid that trap is to stop measuring yourself against others. You are not racing them. You are building your own process. You're learning to trade your system with your risk profile. If someone else made $5,000 today, it doesn't mean anything unless you could have made that trade too, by your rules. And most of the time, you couldn't. So let it go. Now let's talk about regret, because regret is the fuel of FOMO. You miss a big move and you think, if I had just entered. That if is dangerous. It creates a fantasy. You imagine all the money you could have made. But here's the thing, missing a trade is not a mistake. It's part of trading. Not every move is meant for you. Some trades you should miss because they don't align with your system. What matters is not how many moves you catch. It's how many good trades you take over time. There's a concept I teach all my clients. One good trade. Focus on making one good trade per day. Not the biggest trade, not the fastest, just one trade that followed your plan. If you can do that consistently, you'll build confidence. And confidence kills FOMO. Because at its core, FOMO is not about missing out. It's about insecurity. It's about not trusting yourself. It's about needing the market to validate you. But once you have confidence in your process, you stop chasing. You start choosing. You become the hunter, not the prey. Before we close this chapter, I want you to reflect on this. What's more painful, missing a trade or entering one you regret? Because one costs you nothing, the other can cost you everything. FOMO is sneaky. It disguises itself as opportunity, but if you look closer, you'll see it for what it really is, a trap. And the only way to escape it is to slow down, stick to your plan, and stop chasing green candles. Remember this, the best traders aren't the fastest. They're the most disciplined. They wait for their moment, and when it comes,
Chapter
they
2.
strike with
The
confidence,
dopamine trap.
not fear.
Have you ever felt a rush right after placing a trade, even before it moved in your favor? That little jolt of energy, that sudden spike of excitement, that feeling like something big is about to happen. It's like your brain lights up. You feel alive, focused, maybe even a little addicted to the moment. And if the trade goes green for a second, your heart starts racing. You check your phone every few minutes, even if you're out at dinner. You can't stop thinking about it. Sound familiar? That's not just you being excited. That's dopamine, the chemical behind every impulse, craving, and thrill in your trading behavior. Here's the truth no one tells you. You're not trading charts. You're trading chemicals. Dopamine is the brain's motivation drug. It's what drives desire. It's what makes you chase something even when logic says wait. And in trading, dopamine is everywhere. Every green candle, every alert sound, every time you refresh your P&L, it's all triggering dopamine spikes in your brain. And over time, those little spikes form habits. And those habits can lead to dangerous behavior. Most people think dopamine is a reward chemical. It's not. Dopamine doesn't get released when you win. It gets released when you anticipate a win. It's the chase, not the catch. That's why you get that rush even before the trade plays out. The act of placing the trade, checking the chart, waiting for movement, it all lights up the same pleasure circuits as gambling, junk food, or social media. This is the dopamine trap. It feels like motivation, but it's really manipulation. Your brain starts to seek the feeling instead of the result. You're no longer trading for smart entries. You're trading for a chemical high. You're chasing a buzz, not a setup. Let's break it down a bit more. You wake up in the morning. You check your phone. You open Twitter or Discord. You see someone post a trade that's up 60% pre-market. Instantly, your brain triggers dopamine. You didn't make the money, but the possibility that you could have gets you excited. That's the power of anticipation. You start scanning the market not because you see a setup, but because your brain wants that hit. You're no longer hunting quality. You're chasing stimulation. This is why FOMO is so hard to resist. It's not just about missing opportunity. It's about craving a feeling. And if you've trained your brain to associate trading with pleasure, then even bad setups will look tempting. You'll talk yourself into a risky trade just to feel like you're doing something. That's how the trap works. It makes you confuse action with progress. And the scary part? The more you feed this cycle, the stronger it gets. Your brain starts rewiring itself to seek dopamine constantly. You stop being patient. You get bored if the market is slow. You feel restless if you're not in a trade. Even if you know a setup isn't clean, you still jump in because not trading feels worse than losing. That's the addiction. Now, let's get personal. There was a trader I mentored. Let's call her Elena. She was sharp, disciplined, and had a solid risk management plan. But over time, I noticed something strange. She would make good trades early in the week. But after a few wins, her behavior changed. She started forcing trades by Thursday and Friday. She admitted she felt empty if she wasn't active. It wasn't about money anymore. It was about not feeling left out. When we looked deeper, she realized that the trades weren't about setups. They were about chasing the emotional high. That's dopamine dependency. Think of it like this. Every time you take a trade out of boredom or emotional impulse, you're reinforcing that loop in your brain. You're teaching your mind to crave the wrong signals. And the more you do it, the harder it becomes to recognize good trades. Because now, it's not about quality, it's about instant satisfaction. This is why some traders say they can't help themselves. They're not weak, they're wired. And it's no different than someone addicted to scrolling on TikTok or constantly checking likes on Instagram.
The brain doesn't care if it's a trade or a tweet. It just wants the hit. But here's the good news. You can break this cycle. And the first step is understanding that discipline isn't just a personality trait. It's a brain skill. You have to retrain your brain to delay gratification. Start by noticing your urges. The next time you feel that sudden rush to jump into a trade, pause. Literally, pause. Don't act. Just observe the feeling. Ask yourself, is this trade part of my system, or is this just my brain looking for stimulation? That one pause can change everything. You can also set rules that protect you from yourself, like only trading at specific times, or limiting the number of trades per day, or journaling your emotional state before every entry. These small habits build awareness, and awareness breaks the autopilot loop. And the most powerful tool is removing dopamine triggers from your environment. That means unfollowing hype traders who post giant green screenshots with zero context. It means muting Discord alerts that tell you to ape in without any risk plan. It means closing your live P&L when you're in a trade, because watching the number tick up and down just feeds your addiction. Your job as a trader isn't to chase excitement. It's to control your state. And that starts by lowering your exposure to emotional triggers. Here's a wild truth that most don't realize. Boredom is a superpower in trading. Think about it. Some of the best trades happen after hours of waiting. Great setups don't scream at you. They build slowly. They require patience. But if your brain is used to constant dopamine, boredom feels painful. You'll jump into trash setups just to escape that feeling. So how do you fix it? You have to get comfortable being bored. Learn to love the wait. Teach your brain that nothing happening is sometimes the best thing happening. Because when you can sit still and do nothing until the market aligns with your plan, that's when you start trading like a pro. Let me share something that helped me during my own journey. I started viewing trading like hunting. A real hunter doesn't shoot the first thing that moves. They wait. They track. They study the environment. They only take the shot when they know it's the right time. That level of patience and focus is what separates the amateurs from the professionals. And you can't hunt if your brain is hyper-triggered by dopamine. You need clarity. You need emotional stillness. And to get that, you need to rewire your brain. Here's another mindset shift that helps. Detach from the outcome. Most dopamine loops are fueled by obsession with results. Will I win? How much can I make? Is this the one? But here's the hard truth. You can't control the outcome of any single trade. You can only control the process. When you shift your focus from how much money will I make to did I follow my system, you reduce dopamine's grip on you. Because now the reward isn't the profit, it's the execution. This shift changes everything. It's how you move from emotional trading to strategic trading. It's how you stop needing the trade to feel good and start trusting the process to work over time. Now, let's close this chapter with something powerful. You're not broken. You're not weak. You're not disciplined. You're just human, and your brain is doing exactly what it was designed to do: seek pleasure, avoid pain, and chase the next high. But just because that's your brain's default doesn't mean you have to obey it. You can take control. You can rewire your impulses, you can create new habits, and you can trade with clarity, not craving. And when you do that, trading becomes something entirely different. It becomes calm, intentional, repeatable, profitable. You stop being a dopamine junkie, and you start becoming a consistent trader.
Chapter 3. The
That's the
illusion
real
of
win.
missing out. Let's begin with a simple question. What if you're not really missing out? What if FOMO is just an illusion, one carefully designed by your brain, the market, and social media? Every trader at some point feels it.
You're sitting in front of your screen, watching a stock make a massive move. It's going vertical. The ticker is running. You weren't in early. You didn't take the trade. And now your mind starts screaming, I missed it. That could have been me. I need to jump in before it's too late. Your hands move before your mind can process. You're not entering with logic. You're reacting out of fear. Not the fear of losing money, but the fear of being left behind. That's FOMO in its rawest form. But let's take a step back and look deeper. FOMO is never about the market. It's about your relationship with opportunity. See, the market will always offer opportunities every single day, every single week. Whether it's a breakout, a dip buy, a trend reversal, or an earnings play, there will always be something moving, something you could have traded, something you might have profited from. And if you're not careful, your brain will start treating every missed trade as a personal failure. But here's the truth. You didn't miss out. You passed on something that wasn't yours. You didn't miss the opportunity of a lifetime. You missed a setup that didn't match your plan. That's not failure. That's discipline. The illusion of missing out is powerful because it plays on one of the deepest human fears, the fear of regret. As humans, we hate the idea that we could have done something but didn't. We replay scenarios in our mind. What if I had entered earlier? What if I didn't hesitate? What if I just trusted my gut? But here's the brutal truth. Regret is a liar. It distorts reality. It only remembers the outcome, not the context. That trade you think you missed? Maybe it didn't have a clean setup when it started. Maybe the risk was too high. Maybe it was news-driven and unpredictable. But your brain doesn't remember any of that. It only remembers the end result, the big green move. And so it punishes you emotionally, even though you made the right decision by staying out. Think about that for a moment. You're feeling bad for being disciplined. You're judging yourself not for a mistake, but for exercising patience. That's the real illusion. That's how FOMO tricks you. It makes you believe that every opportunity you don't take is a missed chance to get rich, when in fact, it's often a bullet you just dodged. Let's talk about something every trader has heard. This is a once-in-a-lifetime move. You hear it in chat rooms, you read it on Twitter, some guru says, if you're not in this play, you're missing the biggest opportunity of the year, and your heart sinks. You feel behind. You think, maybe this is the one that'll change everything for me. But let's be honest, how many times have we heard that, and how many times has it actually been true? The idea of once-in-a-lifetime trades is usually marketing, hype, or ego. It's designed to generate excitement, not logic. And when you believe in that myth, you stop trading with strategy, you start trading out of desperation. Here's something professional traders know. There is no last bus. The market isn't going anywhere. If you missed one setup, another is coming. Maybe not today, maybe not even tomorrow, but it will come. And when it does, if you've protected your capital and kept your head straight, you'll be ready for it. But if you chased the last one and blew up your account, you won't even have the capital or the confidence to trade the next one. FOMO doesn't just cost you money, it costs you clarity. It erodes your trust in your own process. It makes you feel like you're always behind, even when you're actually right on track. Let me tell you a story that illustrates this perfectly. I once worked with a trader named Marcus. Smart guy, great at chart analysis. He had a strict rule to only trade breakouts above resistance with confirmed volume. But one day, he saw a biotech stock spike 80% on a press release. No technicals, no setup, just news and momentum. He felt the itch. Twitter was going wild. People were saying it would hit $20. It was already at $15. He broke his rule. He entered late, chasing the green. Within 30 minutes, the stock dropped to $11. He lost over $4,000 on that trade. What hurt Marcus most wasn't the money, it was the realization that he abandoned his process because of the illusion that he was missing out. He later told me, "It wasn't my trade. I knew it, but I still took it because I didn't want to feel left out." That's the key phrase. I didn't want to feel left out. That sentence doesn't have anything to do with strategy and everything to do with emotion. And that's where most traders go wrong. They think trading is about finding the best setup, but often it's about managing your emotional state while everyone else seems to be winning. Because that's what makes FOMO so cruel. It doesn't hit hardest when you lose. It hits when everyone else appears to be winning and you're just sitting on your hands. You open your feed. You see green screenshots, $500 gains, $2,000 scalps, 3R trades, people saying, easy money, and you're still flat on the day. Or worse, red. That comparison, it's toxic. It makes you feel like you're doing something wrong even when you're actually doing everything right. Here's a mindset shift that will save your sanity. Other people's profits are not your opportunity. Their wins don't mean you lost. Their entries don't justify your FOMO. You are running your own race. You are building your own strategy. And if you want to succeed in the long run, you have to learn how to sit with discomfort. Because that's what most traders avoid, discomfort. The discomfort of waiting, the discomfort of watching others win, the discomfort of saying no to a trade that looks juicy but doesn't align with your edge. But here's the paradox. The more discomfort you can handle, the more discipline you'll build. And discipline is what turns you from a gambler to a professional. Let's look at FOMO through a different lens. What if every time you resisted the urge to chase, you weren't missing out, but leveling up? What if every skipped trade that didn't meet your criteria was a rep for your mental muscle? See, most traders try to win the market, but the real win is when you beat your own emotions. When you can watch a stock run and say, good for them, but it's not for me. That's when you've grown. That's when you've moved beyond the illusion of missing out and into the reality of strategic execution. Now let's talk about the cost of missing out. You think missing a trade costs you money, but here's what it actually costs when you chase out of fear. It costs you capital, because late entries often reverse. It costs you confidence, because now you feel out of control. It costs you clarity, because you broke your own rules. And most dangerously, it costs you momentum, because now you're trading to make back what you just lost. That's how one FOMO trade turns into a spiral. You chase one move, it fails. You feel frustrated, so you chase the next one. That fails too. Now you're revenge trading. Now you're no longer following your edge. You're reacting to emotion. And before you know it, you're in a hole, financially and mentally. And all of this started not because you lacked skill, but because you couldn't resist the illusion that you were missing something big. So how do you break the illusion? First, you have to reframe what success looks like. Success isn't being in every move. Success is staying out when you're supposed to. Success is following your plan even when it's boring. Success is trading your edge with consistency, whether the market is exciting or dead. You also have to practice mental detachment. When you see a stock running and you missed it, say this out loud: "That was not my trade." The simple statement helps your brain let go. It reminds you that not every move is yours to catch, and that's okay. Lastly, remind yourself of this core principle. The goal isn't to catch everything. The goal is to catch what aligns with your system. Missing trades is part of the game. Chasing them is not. When you truly accept that, the illusion starts to fade. You stop feeling like you're behind. You stop measuring yourself against strangers on social media. You stop jumping into setups that don't belong to you. Instead, you stay grounded, patient, focused. And that's when the magic happens. That's when you start seeing the market clearly, not through the fog of emotion, but through the lens of discipline. So next time you feel that itch, that panic, that urgent fear of missing out, pause. Breathe. Ask yourself, is this trade part of my plan or part of the illusion? Because once you can answer that honestly,
Chapter 4.
you've
From
already
reactive
won.
to strategic. FOMO makes you fast. Strategy makes you rich. If you've ever placed a trade in the heat of the moment, you know exactly what reactive trading feels like. Your heart races, your screen blinks, a green candle jumps, and before you know it, click, you're in. Maybe you made money. Maybe you didn't. But deep down, you knew it wasn't a trade. It was a reaction. That kind of trading may give you a thrill, but it won't give you consistency. It won't build wealth. It won't lead to long-term success. Because when you're reacting, you're not trading, you're gambling. And the brutal truth? Most retail traders are gamblers with charts in front of them. But here's the good news. You can rewire yourself from reactive to strategic. You can learn to trade based on logic, rules, data, and discipline. You can become the type of trader who waits for their moment, not the one who panics to be part of someone else's. Let's start by understanding the real difference between reaction and strategy. When you're reacting, you're being driven by external forces. Price action moves fast, a stock is trending on Twitter, your friend sends a buy now message in a group chat, and you jump. You didn't plan it, you didn't analyze it, you didn't think it through. You just responded to what was in front of you, reactively. In that state, you're not in control. The market is. Strategic trading is the opposite. It's quiet, it's calm, it's premeditated. A strategic trader knows what they're looking for before the day even starts. They have their levels marked. They have a plan for different market conditions. They know where they'll enter, where they'll exit, and how much they'll risk before they click the mouse. Strategy removes emotion. Reaction feeds it. Most traders say they have a strategy, but when you look closer, they're still reacting. They say things like, "I had a feeling it would run," or "it looked strong," or "everyone was talking about it." That's not strategy. That's noise wrapped in justification. To become strategic, you have to shift from hoping to planning. Hope is dangerous. Hope says, "I think this might go up." Strategy says, "This matches my A+ setup that I've backtested 100 times, and I'm risking $100 to make $300 with a clear stop loss." See the difference? One is a wish, the other is a system. And here's the key. You can't build a system if you're always reacting. Strategic trading starts before the market opens. It begins with preparation. This means scanning the market, identifying quality setups, marking key levels, writing down trade plans, and knowing exactly what you'll do depending on how price behaves. This is how professional traders approach every day. Reactive traders wake up late, open their platform, and start clicking around looking for excitement. Strategic traders start with clarity. They've already done the work. And because of that, they don't chase, they wait. Let's pause here for a moment. Have you ever entered a trade and then immediately started asking questions like, "What's my target? Should I add more? Where's my stop?" If you're asking those questions after you're already in the trade, that's a red flag. It means you didn't have a plan. You reacted. A strategic trader never enters without those questions already answered. In fact, most strategic traders can tell you exactly what they'll do in 3 different outcomes. If the trade goes in their favor, if it goes sideways, or if it starts going against them. That's power. That's control. And that's what separates real traders from emotional ones. Let's talk about daily routines because this is where strategic trading becomes a habit. Every morning before the bell rings, you should have a clear plan. That includes your watch list, your key levels, the setups you're watching, and your trade limits for the day. You should know how many trades you're willing to take, how much you're risking per trade, and what your ideal setups look like. Even more importantly, you should have non-negotiables. These are rules you follow no matter what. For example, I don't trade breakouts without volume, or I never enter after 3 green candles in a row, or I stop trading after 3 consecutive losses. These boundaries protect you from yourself. They build structure. They remove impulse.
Strategic traders have systems not just for entries and exits, but for behavior. And behavior is everything. Because here's the truth. Most traders don't blow up accounts because their setups fail. They blow up because they abandon their process in the heat of the moment. They get emotional. They go off script. They double down. They revenge trade. They remove their stop. They add more size trying to make it back. None of those are strategy. Every single one is reaction. So how do you become a truly strategic trader? You start by documenting everything. Every trade you take should be journaled. Entry price, exit price, stop loss, risk to reward, market conditions, emotional state, whether you followed your plan, and what you learned. Over time, this data becomes your greatest asset. It reveals your strengths, your weaknesses, your best setups, your worst tendencies. The more you document, the less you rely on emotion. You start seeing patterns. You start trusting data. You stop chasing random moves and start focusing only on what works. Let me tell you about someone I coached who made this shift. His name was Logan. He had been trading for a year, mostly breakouts, but he had no consistency. He'd have big green days, followed by brutal losses. Every time a stock started running, he'd jump in without thinking. He couldn't help it. He just hated missing out. I asked him to stop trading for 1 week and just journal. Not just price action, but his thoughts, his triggers, his emotions before, during, and after trades. What he discovered shocked him. Almost every losing trade came from a reactive decision. Trades he placed quickly, without confirmation, always ended in regret. But the trades he waited for, the ones that matched his system, those were profitable. That 1 week of awareness changed everything for him. He started trading less, waiting more, planning more, and most importantly, trusting his strategy. Within 3 months, he was no longer reacting to hype. He was executing with purpose. His equity curve went from chaos to consistency, all because he stopped being a reactive trader and became a strategic one. Let's dive a little deeper into execution frameworks because this is where strategy becomes repeatable. Every trade should follow the same flow: scan, identify setup, confirm signal, define risk, enter, manage, exit, then review. It sounds simple, but most traders skip 3 or 4 of those steps. They go from identify setup to enter, with nothing in between. No confirmation, no defined risk, no plan for management. That's not trading. That's guessing. A strategic trader treats each trade like a chess move: thoughtful, measured, intentional. They don't rush. They don't chase. They act only when the board looks exactly how they need it to. And yes, it means you'll take fewer trades. But it also means you'll take better trades. You'll be calmer, clearer, more in control. And in this game, control is everything. Here's something most people don't tell you. The most profitable traders are the most boring. They're not taking 20 trades a day. They're not shouting on social media. They're not chasing every candle. They're quietly executing their edge over and over again with surgical precision. That's what strategy looks like. Now let's address a big fear many traders have. What if I miss a big move while I'm waiting for my setup? You will. That's a fact. You will absolutely miss big moves. And that's okay. Because you're not in this game to catch everything. You're here to catch your trades. The ones that fit your system, your rules, your risk tolerance. Missing a move isn't a loss. It's a decision. And every decision you make based on your strategy, whether it ends in profit or not, is a win for your process. So the next time you feel that rush, that urgency, that itch to jump in without thinking, pause. Ask yourself, am I reacting or am I executing a strategy? Because that one question could be the difference between a blown account and a 6-figure one. This is how you shift from reactive to strategic. This is how you stop chasing and start choosing. This is how you stop gambling and start growing. FOMO will always try to make you fast, but strategy, the real kind, makes you rich. Slow down, plan ahead, trade with purpose, and let the amateurs keep chasing
Chapter
what
5.
you're patiently
Know your
preparing
trigger
for.
zones. If you don't know your trigger, the market will use it against you. Most traders think they're making conscious decisions when they enter a trade. They believe they're in control, acting logically, sticking to a plan. But more often than not, they're not making decisions at all. They're reacting. Not to price, not to patterns, but to invisible forces inside them. Forces they don't even realize are there. These invisible forces are your triggers. And if you don't identify them, name them, and learn how to manage them, they will run your trading life. Let me ask you a question. Have you ever taken a trade you had no business taking and you knew it while you were doing it? You felt something, an itch, a pull, a heat in your chest, and before you even finished thinking it through, you hit buy. Then the regret came, and you told yourself, I don't even know why I did that. That's a trigger. Triggers are not logical. They're emotional, psychological, sometimes even physical. They're mental shortcuts that override your rational mind, and in trading, they are dangerous because they lead to impulse, not intention. If you're serious about becoming a disciplined trader, you need to map your trigger zones, the emotional landmines that cause you to abandon your strategy. The first step in identifying your trigger zones is becoming aware of your patterns. You probably already have them even if you don't realize it yet. Maybe it happens after you see someone post a $5,000 gain on Twitter, or when you miss the morning move and feel like the day's slipping away. Maybe it's after a losing streak, or when you're trading tired, bored, or angry. In those moments, something switches in you. You feel off. You don't think straight. Your brain whispers, let's just do one more trade. That whisper is a trap, and the more you obey it, the stronger it gets. One trader I worked with, let's call him Tyler, used to blow up every Friday. He would trade relatively well from Monday through Thursday, but Friday was always chaos. When we looked at his data, the pattern was clear. His worst trades, his biggest losses, his most impulsive decisions, almost all happened on Fridays. Why? Because Tyler had unknowingly created a psychological deadline. He wanted to end the week green. That pressure created a trigger, and that trigger led to him forcing trades, chasing setups, doubling his size, and blowing up. Once he identified Friday as a danger zone, everything changed. He started limiting his trades on Fridays. He switched to paper trading if he was up for the week. That small adjustment stopped the bleeding and gave him space to build consistency. That's the power of knowing your trigger zones. Let's take a step back and define what a trigger zone actually is. A trigger zone is any situation, emotion, environment, or mental state that increases the likelihood of you trading emotionally. Triggers can be internal or external. Some come from inside you, like fear, stress, overconfidence, or boredom. Others come from outside, like Twitter hype, market volatility, or seeing someone else win. Either way, they all lead to the same place: you taking a trade you shouldn't. Here's what makes triggers so tricky. They don't always feel bad. Some of them feel good, like when you've had 3 green days in a row and you feel invincible. You think you're in flow, but that high can be just as dangerous as fear. It makes you overtrade, increase size, and chase setups you'd normally skip. Overconfidence is a sneaky trigger. It disguises itself as skill, but it's still emotion, and emotion is what kills discipline. Other traders get triggered by revenge. You take a loss, it stings. Now you feel like the market owes you something. You start looking for the next setup, not because it's part of your system, but because you need to make it back. You're not analyzing anymore, you're hunting emotionally. You're trading from a wounded place. This spiral is one of the fastest ways to blow up an account. Then there's boredom, an underrated but deadly trigger. The market is slow. You're staring at your screen. Nothing's happening. You start feeling agitated. The silence is uncomfortable. So you take a trade, not because it's a good setup, but because you're looking for stimulation. That's not trading. That's self-medicating with action. And let's not forget the social triggers. You're in a trading group. Everyone's posting their wins. Someone just caught a huge move. Another trader is calling out a play about to explode. Suddenly, you feel behind. You feel like you're missing the move. That pressure creeps in. Now you're not evaluating setups, you're comparing timelines. And comparison is emotional poison. When you don't know your triggers, you become vulnerable to all of them. You're like a ship in the ocean without a rudder, going wherever the waves and tweets take you. But when you do know your triggers, everything shifts. You start noticing patterns. You catch yourself in the moment. You feel the emotion rising, but now you can interrupt it. You can pause. You can step back, and you can say, "This is a trigger. I know this feeling. I don't have to obey it." That pause, that's the beginning of mastery. So how do you identify your personal trigger zones? The first step is journaling not just trades, but emotions. Start writing down what you felt before, during, and after every trade. What was going on in your life? What did the market feel like? Were you calm? Rushed? Frustrated? Did you feel the need to prove something? Did you feel the urge to make back a loss? Over time, you'll start to see patterns. Maybe you get triggered after 2 red trades in a row. Maybe you get triggered after a big win. Maybe you trade worse after scrolling social media for 30 minutes. These small insights are gold. They give you a map of your internal landscape. Once you have that map, you can start setting pre-trade filters. For example, if you know you trade poorly when you're tired, you can decide, no trading unless I slept 7+ hours. Or if you know hype triggers you, you can limit social media use before market open. These boundaries protect you from your worst tendencies. Let's go even deeper. Every trigger has a core emotion underneath it. FOMO is often just a surface symptom. Underneath it is fear. Fear of being left behind. Fear of not being enough. Fear of missing your chance to finally break through. When you trace the trigger back to its root, you find belief systems that are quietly driving your behavior. A trader I worked with, let's call her Jess, kept blowing trades when others were watching. In her Discord community, she felt like she had to prove she was smart. If she wasn't in a trade, she felt invisible. That pressure to perform triggered impulsive decisions. When we dug deeper, we found the belief, if I don't show wins, I won't be respected. That was her real trigger. Once she saw that, she began shifting. She turned off Discord during market hours. She started trading solo. Her confidence grew, not because she changed her strategy, but because she stopped reacting to her emotional wound. That's what this chapter is really about. It's not just about identifying when you get emotional. It's about understanding why. And once you understand why, you gain power. Let's bring this home with a personal exercise. Start building a trigger journal. Create 2 columns, one for external triggers, things like social media, missed trades, market volatility, and one for internal triggers, like fear, boredom, anger, overconfidence. Every time you take a trade that feels impulsive, go back and write down what triggered it. Over time, this becomes your emotional roadmap. Your goal isn't to eliminate all emotion. You're human. You'll always have feelings. But the goal is to know yourself so well that emotion no longer surprises you. It no longer sneaks up and hijacks your trades. You become the observer, the one in control. And when you're in control, you can trade from clarity, not chaos. Here's the last insight I'll leave you with. The market isn't designed to just take your money. It's designed to use you against yourself. It will trigger your greed, your fear, your ego, your doubt. It knows where you're weakest, and it will hit those pressure points over and over again, until you either surrender or become unshakable. Mapping your trigger zones is how you become unshakable. It's how you stop being a puppet and start being a professional. It's how you stop reacting and start responding. It's how you move from being a victim of your impulses to being the architect of your process. Know your trigger zones, master them, and you'll master yourself. And once you master yourself, no market condition
Chapter
can
6.
ever truly
Patience
break you.
pays more than speed. If trading had a slogan, it would probably be act fast or miss out. But if wealth building had a slogan, it would be wait longer than everyone else. There's this strange contradiction in trading. We're taught to move fast. We see the market move in milliseconds. We hear people say things like, you have to be quick or you'll lose the move. The flashing candles, the alerts, the hype, it all builds this internal pressure. It feels like if you're not fast, you're falling behind. But here's the truth that almost every successful trader eventually discovers. Speed is rarely the reason you win. More often, it's the reason you lose. Because in trading, the one who waits wins. Let's get something clear up front. Patience isn't just sitting around doing nothing. It's not laziness. It's not avoidance. It's control. Patience is a skill, one that gives you power over your impulses, your emotions, and the chaos around you. It's the calm between the setups. It's the silence before the sniper shot. And in a world where everyone's trying to shoot first, the sniper makes more money than the cowboy. Most retail traders are like cowboys in a bar fight. Guns blazing, trades flying, no plan, just pure emotion. They jump in fast, jump out faster, always looking for the next rush. But their accounts don't grow. Why? Because they're confusing movement with progress. Just because you're doing something doesn't mean you're doing the right thing. Now compare that with the patient trader. This trader may sit through the first 2 hours of market open and take nothing. They might watch 5 setups and pass on all of them. And then, finally, they see it. A clean, high-conviction setup with ideal volume, structure, and confirmation. That's when they strike. One trade, one decision, one calm execution. And that single trade might make more in one session than 10 random trades ever could. So let's ask the big question. Why is patience so hard in trading? Because we're wired for speed. We're wired for instant gratification. The moment we sit in front of the chart, our brains start asking, where's the opportunity? What's the move? How do I not waste this session? That pressure builds. And without discipline, we start convincing ourselves that any movement is worth acting on. That's where FOMO sneaks in again. It whispers, if you don't take this, you'll regret it. But what it doesn't tell you is that you'll regret losing money on a rushed trade a lot more. I've seen this cycle play out hundreds of times. A trader wants to prove themselves. They want results fast. They take every semi-decent setup that pops up. Their winners are small, their losers are big, their emotions are always running ahead of their analysis. And slowly, they start doubting themselves. That doubt doesn't come from the market. It comes from a lack of patience. Now, let's talk about a trader I once coached, Jason. He had solid technical knowledge. He could chart with precision, but he kept overtrading. Every day he'd take 6 to 8 trades, sometimes more. When I asked him to look at his journal, we noticed something wild. Only 2 or 3 of those trades matched his strategy. The rest were emotional. So I gave him a challenge. For the next 5 trading days, you can only take 1 trade per day, and it has to be A+ quality, no exceptions. At first, he hated it. It felt restrictive. He felt like he was missing out. But something amazing happened by day 4. He started to see the difference between good and bad trades more clearly. His patience created space for clarity. By the end of the week, he was green, and more importantly, calm. No more revenge trades, no more rushing, just one focused decision a day. His equity curve didn't just improve, so did his confidence. That's the quiet power of patience. It gives your brain room to breathe. It gives your system space to work. It gives you time to decide instead of react. Let's talk now about what patience actually looks like during a trading day. It's not just waiting to click buy. It's also waiting for confirmation, waiting for volume,
waiting for pullbacks, waiting for entries that make logical sense, not emotional sense. Sometimes it's even waiting after you've entered the trade, waiting for the setup to work instead of bailing out the moment it turned red. A lot of traders lose money not because their setup was wrong, but because they couldn't wait long enough for it to work. They enter, it goes a little red, and they panic. They cut the trade. And 5 minutes later, the trade goes exactly where they wanted it to. That's not a bad setup. That's bad patience. And here's something most new traders don't realize. Patience actually lowers your risk. Because when you wait for only the best setups, the clean ones, the ones that check every box, you're entering with better odds. You're not guessing, you're following a repeatable process. That reduces slippage, it reduces drawdown, and it increases your long-term profitability. Let me give you a phrase to burn into your brain. Patience isn't passive, it's preparation. Every moment you're waiting, you're preparing for the right trade. You're protecting your capital for the right moment. You're reserving your emotional energy for when it counts. You're staying neutral. And neutrality is one of the most powerful states a trader can operate from. Think of patience like a muscle. If you've been reactive your whole trading career, you won't suddenly become zen overnight. You have to train it. Start small. Start by skipping one mediocre trade per day. Then try 2. Then try a full session without trading, just observing. You'll be amazed at how much clarity you gain when you remove the need to be in something. There's another powerful concept here. The cost of doing nothing is often lower than the cost of doing something stupid. But the market won't tell you that. It will always make you feel like doing something is better than doing nothing. But the patient trader knows doing nothing is sometimes the most profitable move of the day. Let's talk about late entries for a moment. FOMO traders often enter trades after the move has already started. The stock is already broken out, the candle is extended, and they jump in late. Why? Because they couldn't wait for the setup to come to them. They chased it. And what happens? They buy the top. Now imagine this instead. You saw the setup forming earlier, but it wasn't ready yet. Instead of rushing in, you wait. You watch. You let the pattern play out. You let volume confirm. You let price pull back. And then, when the timing is right, you enter. Clean, focused, prepared. That's not just a better entry. That's a better trader. Because good entries are the result of good behavior. And good behavior comes from patience. Let's bring this into real life for a moment. Think about relationships. Rushing into one because you're lonely usually leads to regret. But waiting for the right person, the one that aligns with your values, that leads to something lasting. Or think about fitness. You don't get in shape overnight. You get in shape by consistently doing the right thing over a long period of time. The people who try to go fast, extreme diets, overtraining, they burn out or break down. But the ones who trust the process, stay consistent, and play the long game, they win. Trading is no different. Speed looks exciting on the outside, but patience builds equity on the inside. So, how do you train yourself to become more patient? You start by changing what you value. If you value action, you'll always be chasing something. But if you value quality, you'll start waiting for only the best. You'll stop needing to be in a trade every moment. You'll start being okay with watching more than acting. And eventually, that becomes your edge. You'll become the trader who doesn't flinch, the trader who doesn't chase, the trader who knows, my setup will come. I just have to be ready. Here's the final lesson. Patience is not just a trading skill. It's a life skill. It shows up in how you handle drawdowns, how you handle slow days, how you handle success, failure, and uncertainty. It's the ability to wait without breaking down, to sit still when your instincts say move, to trade from a place of strength, not stress. Because in the end, trading isn't about speed. It's about timing. And timing belongs to those who
Build
wait.
your inner calm. You can't control the market, only your emotions. This simple truth is one of the hardest for traders to accept. We spend hours studying charts, analyzing indicators, reading news, and trying to predict where the price will go next. But no matter how much effort you put into predicting the market, the one thing you can control, your emotional response, is often ignored. The market will always throw curveballs. Unexpected news, wild price swings, sudden reversals, and gut-wrenching losses are part of the game. But how you react to these moments is what determines whether you survive, thrive, or crash. For FOMO traders, emotional control isn't just helpful, it's life or death for their account. FOMO is emotional noise, a storm in your mind that drowns out logic. Without inner calm, you'll always be chasing, panicking, and losing. The good news is, calmness is a skill. It can be learned, it can be practiced, and it can be strengthened. Let's start by understanding what inner calm really means. Inner calm isn't about suppressing emotions or pretending you're a robot. It's not about avoiding feelings or pushing down stress. Inner calm is the ability to notice your emotional state without being overwhelmed by it. It's the space between stimulus and response, where you choose how to act instead of reacting automatically. Imagine a stormy sea. Your emotions are the waves, sometimes crashing, sometimes gentle. Inner calm is the anchor that keeps your ship steady no matter how wild the waters get. So how do you build this anchor? How do you become the calm in the storm? It starts with awareness. Mindfulness is a powerful tool for traders, but it's often misunderstood. Mindfulness isn't about meditation cushions or chanting mantras, though those can help. At its core, mindfulness is simply paying attention, on purpose, to the present moment without judgment. In trading, this means noticing your thoughts, feelings, and bodily sensations as they happen. Are your hands trembling as you watch the price drop? Is your heart racing after a news headline? Are you feeling desperate or greedy? The key is to observe these emotions without immediately acting on them. When you practice mindfulness, you create a mental pause. Instead of immediately clicking buy or sell when a wave of fear or excitement hits, you take a breath and step back. That pause, however brief, creates choice. And choice is freedom. One trader I coached, Emma, struggled with impulsive trades driven by anxiety. Every time the market moved quickly, she felt an uncontrollable urge to jump in or exit. We started practicing simple mindfulness exercises. Before trading, she would take 3 deep breaths and mentally check in. What am I feeling right now? Am I calm or anxious? Am I making a choice or reacting? Within weeks, Emma's impulsive trades dropped dramatically. She became more patient, more focused, more consistent. This is not magic. It's muscle memory for your brain. Another foundational tool for building calm is journaling. Keeping a trading journal isn't just about recording numbers and setups. It's about exploring your emotional landscape. Writing down what you felt before, during, and after trades helps you spot patterns that you can't see in real time. Journaling turns your internal chaos into data you can analyze. You start noticing triggers, like frustration after losses, overconfidence after wins, or anxiety during volatile markets. Journaling also acts as a release valve. Instead of bottling up stress or letting emotions swirl in your mind all day, you put them on paper. This simple act reduces their power.
I once worked with a trader named Lewis who felt overwhelmed by the pressure to perform. His journal wasn't just about profit and loss. It became a safe space where he could honestly write about his fears, doubts, and hopes. Over time, journaling helped Lewis recognize that most of his losses came during emotional overload. With that insight, he adjusted his trading routine, taking breaks when feeling stressed. Your journal is your emotional GPS. Use it to guide your growth. Let's talk about one of the simplest and most effective tools to calm your nervous system in the moment: breathing. The breath is unique. It's the only bodily function you can control voluntarily, but it also happens automatically. Because of this, breath control is a powerful gateway to influence your mind and body. When anxiety strikes, like when a trade suddenly moves against you, your breathing becomes shallow and fast. This triggers your fight-or-flight response, flooding your body with stress hormones and clouding your thinking. But the moment you slow your breath down and breathe deeply, your body gets the signal that it's safe. Your heart rate drops, your muscles relax, and your mind becomes clearer. A simple breathing technique you can practice anywhere is called box breathing. It works like this. Inhale slowly for 4 seconds, hold your breath for 4 seconds, exhale for 4 seconds, and pause for 4 seconds. Repeat this cycle. Several times can quickly reduce tension. Another technique is diaphragmatic breathing, where you breathe deeply into your belly instead of shallowly into your chest. This kind of breathing activates your parasympathetic nervous system, the body's rest and digest mode. When I taught these techniques to a trader named Raj, who often panicked during volatile sessions, he found a new level of composure. Instead of selling his position at the first sign of trouble, he used breathing to calm his mind and think clearly. His trades became more deliberate, his losses smaller. Breathing is the reset button of your nervous system. Don't underestimate its power. Building inner calm also means creating rituals around your trading routine. Rituals anchor you. They prepare your mind and body to enter a state of focus and discipline. For some traders, this might be a short meditation before market open. For others, it could be a walk, stretching, or simply turning off distractions. Whatever your ritual is, it should help you step into your trading day grounded and centered, not rushed and scattered. Many professional traders have pre-market routines that include mindfulness and journaling precisely because it sets the tone for the day. You don't need to spend hours. Even 5 minutes daily can make a big difference. It's also important to build boundaries between your trading life and personal life. Emotional exhaustion from overtrading or obsessing over every tick is a real danger. Your brain needs downtime to process, recharge, and reset. One common trap is compulsively checking your positions, news feeds, and charts outside of your planned trading hours. This hypervigilance increases stress and feeds FOMO. Setting clear trading hours and sticking to them is part of building inner calm. When the bell rings to end your trading session, close your charts. Step away. Do something completely unrelated. Go for a walk, call a friend, read a book. Remember, a calm trader today is a profitable trader tomorrow. Let's not forget the power of self-compassion in this journey. Trading is a hard profession. You will make mistakes. You will take losses. You will have days when the market breaks you. If you beat yourself up every time you make a mistake, you add another layer of stress and anxiety. This only fuels FOMO and reactive trading. Instead, learn to treat yourself with kindness. Acknowledge that errors are part of learning. Forgive yourself quickly. Use mistakes as feedback, not punishment. This mindset softens the emotional storms and builds resilience. I once worked with a trader named Sarah who had a habit of obsessing over every loss. She'd replay bad trades in her head for hours, convincing herself she was a failure. When she shifted to a more compassionate mindset, she noticed her trading improved dramatically. She became more patient. She became more willing to accept losses as part of the process. Inner calm isn't about being perfect. It's about being human and still standing tall. Finally, remember that building inner calm is a journey, not a destination. You won't wake up one day magically free from emotional
8.
turmoil.
Trade
Markets
like a
will
CEO. CEOs don't panic. They execute. This statement may seem obvious, but it hides a powerful truth. Trading isn't just about guessing the market right. It's about running a business, your business. And if you want to succeed, you need to think like a CEO, not a gambler. Most traders treat the market like a casino. They bet emotionally. They chase losses. They ride the highs and crash on the lows. This roller coaster feels exciting, but rarely leads to consistent profits. But a CEO is calm, strategic, disciplined. They don't let emotions run the show. They build systems. They manage risk like it's their lifeblood because, for a business, it is. The difference between a trader who blows up their account and one who builds steady wealth often boils down to this mindset shift, from impulsive player to strategic CEO. Let's start with the core idea. Your trading is your business. Imagine if you owned a company. You'd have a plan, right? A budget, a risk management strategy, employees or systems to support growth. You'd review performance regularly and adapt to challenges. Why? Because businesses don't succeed by accident. They succeed through planning, execution, and continuous improvement. Your trading account is the same thing. If you want to trade like a CEO, you must treat your trading capital as your operating budget, money that you protect, invest wisely, and manage meticulously. One of the biggest mistakes traders make is treating their trading account like a personal ATM or a video game scoreboard. They risk too much on a single trade, chase after quick wins, or let emotions dictate position size. But CEOs know this. You protect your capital first, profits second. Your first job is survival. Without capital, there's no business. This means setting strict risk management rules. A CEO sets policies to avoid bankruptcy. A trader must do the same. This might sound boring, but it's the backbone of longevity. One trader I worked with, Tom, used to risk 10% of his account on every trade. He thought big risk meant big reward. The result? He blew up 3 accounts in 2 years. Then we redefined his mindset. Risk only 1 to 2% per trade. Suddenly, losing trades stopped destroying him. He could stay in the game longer, learn, and grow. This small change was the turning point. Tom went from reckless gambler to responsible CEO of his trading business. Another key CEO trait is systemization. CEOs don't rely on guesswork or gut feelings. They build systems to make decisions repeatable and scalable. They write down processes, automate workflows, and track key metrics. In trading, systemization means having a clear strategy. When do you enter? When do you exit? How do you size your positions? What signals do you trust? What's your maximum daily loss? The more you document and follow your system, the less room there is for emotional impulses. Your system becomes your safety net. Think of your trading journal as your business's financial report. It shows what's working and what's not. CEOs don't ignore their reports, they analyze them deeply and make changes. One trader, Lisa, found that by journaling her trades meticulously, she discovered that her best setups were in the first 2 hours of the market. She adjusted her trading hours accordingly and stopped chasing trades later in the day when she was tired and emotional. Her profits rose, her stress fell. That's CEO-level thinking.
CEOs also know the power of review and adaptation. Markets change, strategies become outdated. What worked last year might fail today. Successful CEOs hold regular performance reviews and pivot quickly. As a trader, you should schedule weekly or monthly reviews. Look at your results objectively. Identify mistakes. Celebrate wins. Adjust your rules. Don't be afraid to scrap parts of your system that don't work. Remember, flexibility is strength. Many traders get stuck in sunk cost fallacies, holding on to bad strategies because they invested time in them. CEOs know when to cut losses in business. Traders should do the same. Another crucial lesson from CEOs is emotional detachment. CEOs don't take every customer complaint personally. They don't panic over a bad quarter. They see their business as something bigger than one day, one loss, or one client. Traders must do the same. Your trades are not your identity. A losing trade is not a reflection of your worth. This mindset reduces emotional trading and FOMO. If you lose a trade, you simply review and move on. If you win, you don't get cocky. You keep executing your plan. This emotional detachment builds resilience, the CEO's most valuable asset. Let's talk about delegation, another CEO superpower that traders often overlook. While you are the CEO of your trading business, that doesn't mean you have to do everything alone. Many successful traders use technology, automation, and mentorship to support their growth. They use alert systems, automated orders, or even hire coaches. If you find yourself overwhelmed, stressed, or making emotional decisions, consider what you can delegate or automate. It might be as simple as setting stop losses automatically or using a trading platform that enforces your risk limits. No CEO runs their company alone, and neither should you. Lastly, CEOs have a growth mindset. They don't see failures as the end, but as lessons. They invest in education, training, and tools. They network with other professionals and continuously look for ways to improve. As a trader, adopting a growth mindset means you welcome feedback, even harsh feedback. You study your mistakes, you read books, take courses, and learn from experienced traders. This mindset keeps your business evolving and thriving. If you ever feel stuck or overwhelmed, remind yourself you are the CEO of your trading business. You have the power to set rules, build systems, manage risk, and grow. FOMO will always be there trying to pull you into reckless decisions, but a CEO doesn't cave to pressure. They execute with strategy and discipline. The next time you feel the itch to chase a trade impulsively, ask yourself, am I acting like a CEO right now? Am I protecting my business? Am I following my system? If the answer is no, take a step back, breathe, and realign with your role as a professional. Trading like a CEO doesn't just increase profits, it transforms your mindset, reduces stress, and builds lasting success. Start today. Treat your trading like the business it is. Because when you trade like a CEO, FOMO doesn't stand a chance.